What's up, guys? Hope you're keeping well. This video is going to be an introduction to the EPVs of lump sum benefits. Lump sum benefits being the different insurance products that are being offered. So this is where science stuff gets to get a whole lot of fun for me because we're combining contingencies, those probabilities with present values of these different products. So a whole lot of fun. So EPV, when I'm talking about EPV, that's expected present value. That's what I'm going to be talking about throughout this video. And I want to stress right now at the beginning, when we talk about EPV, whenever we're calculating an expected present value, all that is, it's the product of our present value and the probability. This probability being the probability of us being paid out this amount that we're being insured for. So like if we survive a term, we'll be paid out an amount. So what's the probability that we survive the term, or what's the probability that we die within a specific term? So that's what the products are that we're going to be getting into. Let's get into it, and it might make some more sense. The first one is a pure endowment. This is, for me, is like the simplest one, and when I draw out the timeline, you'll see why it's so simple. So this is an insurance product that's going to pay out a benefit if the insured life survives the policy term. So all of these, we're talking about 5 different insurance products here, right? And all of them are going to have their own notation. So this might be new if you've never seen it before. This one is N with a line above the N, okay? It's important, that line is a capital S. And then the X stands for a person aged X, and then the term is N. Maybe I should probably write that. N is the term. So let me draw out the EPV of this product on a timeline. You might see why. That'll be times 0, and maybe this is our term N. So as we said, this product is only paying out if we survive our term. So let's say this is our term. So now we've got this product nice, and then we survive, we're going to get paid out this amount. And remember, when we're calculating an EPV, all I said, it's the present value times the probability. So it should make sense that we just need to present value this amount that we're short for and multiply it by the probability of being alive at this time. That's where the contingencies come in, and then present valuing comes in. You see, so it's only one value that we're present valuing, why we're discounting to times 0. This AX dot N, this EPV is equals to VN times by NPX, which you should remember from contingencies and all the discounting we've done, right? This is to calculate the present value, and this is the probability of being alive at that time. Very simple. I don't think that's too hard to get around. The next one we're doing is term assurance. It's slightly more complicated, but it's nothing too crazy. So this is a product that pays out on the death of an insured life within the policy term. So these no, let me not do the line here. Let me do the notation. AXN. So you see how the previous one we had this line on top of the N. Now the line is on top of the X. And stupid way that I actually remember this when I first started with this notation, right? You see this cap on the N. I think of that as like a shield or something, and this line could be like a dart or something falling from the sky. So this and the X and the N are people. So now this N is protected from this thing falling from the sky, so it's surviving the term. As for this one, it's not being protected from this falling object. So this one, unfortunately, does not survive. That's why this product is talking about the death within the term. Or maybe that's this, if you can remember it without that, awesome. So what was I going to say about this, right? So if you want to calculate this one, the formula is quite a bit. It was like this. So working with this one, equals to AX minus NPX VNA X plus N. Actually, I'm not going to talk about this formula because I haven't spoken about this AX yet. So let's just leave that there. But let me draw out the timeline. So I'm going to use the same timeline at the top, but I'll use a blue color now. Stick to green. This timeline at the top, I'm going to use it now just to explain it. Why it's slightly more complicated, because so we're being paid out if we die within a term. So let's say this term is 3 years, right? Here's 3 years, 1 year, 2 years, and then 3 years at the end. That's 3. So we could be paid out if we die over here. We could be paid out here if we die over here. we could be paid out at the end if we die over there. So can you see how already we have to present value 3 different amounts, right? And we have to calculate the probabilities of dying at these 3 different places. So it's slightly more work than the first pure endowment. That was only one payment that was possible. Or you either survive or you don't. Here, there's lots of places to die. Now you can see, imagine now your term is 20 years. That would have been 20 summations. But that's why we have this, right? That makes it easier because that's tabulate. But anyway, we'll get to that. That's all I wanted to say. Next, we're moving on to our whole life products. This is similar to the term assurance, same concept as the term assurance. However, this term is now infinity, so infinite. So whenever we die, we'll be paid out. There's no term. Pays out when you die, irrespective of when you die. So you can think, so now imagine this one. We've got a timeline. It's telling me how many, because n is infinite. Imagine calculating all of these, future valuing every single one all the way, and then calculating all their probabilities. That's too much. So that's why on your life table, this one is tabulated. On your life table, you'll find it there. Sorry, and the notation of this one is a capital A, X. This one doesn't have an N or anything, just capital A, X. So now the next one we're going to talk about is endowment assurance. Endowment assurance, this is the notation. And you see there's no spears, no falling objects, whatever that you want to call that. This, in simple terms, all that this is the sum of a term assurance and a pure endowment. Sometimes this product is also just called endowment without the assurance, but in a question, you'll be able to make out what it is. So this product has a limited term and it's paying out on the death or the survival within the policy term. So quite literally, this is equals to plus, right? It's the sum of a term assurance and a pure endowment. So you can consider the methods we used for 1 and 2, and now we're just summing them. Life assurance, and then you can just already imagine that number 4 would be quite a bit more expensive because it kind of guaranteed a payment, because you either survive or you die. There's not really an in-between. Then the last one we're talking about, number 5, this is our life annuity. So an annuity, we've worked with many annuities now in all the other videos I've done, if you haven't seen those. But now we have to consider the probability of the life being alive at each of the payments. So this one is also tabulated. This value is also tabulated just because now we must calculate present value and probability of being alive at every single payment. Yeah, that's a bit much. So the notation for this one is a small a, X, right? And then you also get temporary ones. I said at the bottom that we can get temporary ones. That's when this notation is introduced, okay? But here we're not getting any lines yet over there or there, none of that. So if we wanted to calculate AX, that would just be equals to the one in advance minus 1. Sorry, there's an X there. However, it's not so simple for this one. If we want AX, let me quickly think. That one is equals to A n minus 1 plus B n NPX. This might have been a lot of notation and stuff to take down, but once you do questions and examples, it'll make more sense. What I want to do quickly now here is write out, if you had to calculate some of these from what we call like first principles, how that would look. So the first one, there's nothing to it. That A, X, and the pure endowment, that's just V in NPX, right? Sorry, this P is looking a bit wonky. Let's rewrite that. NPX, right? Because there's no summations, there's only one possible payment. However, when we go to the term assurance, this one we spoke where there's multiple possible payments, because within the term, if you die, if there's a 10-year term, there's 10 different possible payments, right? And the payments will occur at the end of the year of death, typically. But in the contract, it might be different, but that's what we'll be working with. So this, your one first is going to be like V1 times, no. Right, so I know summations sometimes are a bit intimidating. However, once you practice some questions, you'll come back to this, look at it, and it'll actually make some sense because all it's just a sum. Next one we're working with is whole life. Whole life. Remember, we said our term is infinite. You see, it's exactly the term assurance with a term, an infinite term. You see, that's the only difference here. The next one will be the endowment. The endowment, it's just the sum that we spoke about. Right, that's all there is to it. So you could do the sum of these two separately that I've given over there if you wanted from first principles, because you never know, sometimes maybe you're not given the tables and you're given values to do from a first principles perspective. And the last one we'll do is the small a. So this term's also looking infinite. However, we don't live infinitely. You'll see that like when the ages get very, very high, then the probability of dying is a lot higher, which will tend the payment to zero. Right, so that's that. And then what I included here at the bottom was just these formulas that you can come across and will be useful when you're doing your questions. It was one of these two that pretty handy to remember. It looks like a lot, but it makes sense the more that you do. So I hope this helped. Keep well. See you soon.